I'm happy to be with Rick Rule at the Mines and Money Conference. Rick, tell us about the gold market in your point of view.
You know, if you're from Sprott, you are a gold bug. It's a condition of employment. But the truth is that life has gotten easier for gold bugs of late. The gold narrative, the narrative of public debt, the whole part of the narrative has been in place for a long time. But I think the tipping point, if you will, is zero interest rate and negative interest rate sovereign debt. It took away the last objection to owning gold, which is that gold, unlike other fear trade items, has a negative carry. The truth is now that a lot of government bonds have a negative carry too. So the last impediment to owning gold relative to owning sovereigns has in fact been taken away. The other thing that one needs to look at in a positive sense, or maybe it's a double negative sense, is that never mind that low interest rates take away sort of the reason not to own gold, they take away the positive reason to own bonds. Jim Grant now calls the U.S. 10-year Treasury return-free risk. Think about the concept of return-free risk. It's not particularly attractive. So we think gold might need to digest the gains it's made in the last little while, but we certainly believe it's higher as a consequence of negative interest rates and zero interest rates.
And next, can you talk to us about gold equities?
Well, the gold equities have been in a real tear, and again, they need probably to digest their gains. But the truth is that higher gold prices lead, of course, to higher profit margins in the senior gold stocks. You might not remember the last cycle because you're a bit younger than I, but in the last cycle, the gold industry squandered all the gains. It's amazing in the last cycle that the gold mining industry produced a commodity that went from $260 an ounce to $1,900 an ounce, and free cash flow per share went down. That won't happen this time because the management lessons were learned the last time. The next two or 3 years, you won't see the same malinvestment. You won't see the same stupid takeovers. It's important to know that because that means that the increasing gold price will mean increasing margins and for a change, increasing returns to shareholders. That is exacerbated by virtue of the fact that there are very few good deposits. So when mergers and acquisitions begin to take place, those few companies like Kaminak as an example, or Reservoir Minerals that have high quality deposits will be taken over at eye-popping prices. Increasing free cash flow, the scarcity of good deposits will surprise gold mining stock investors to the upside. It won't happen quickly because we've gone so far so fast, but it will happen certainly.
And are there any junior mining companies that you're focused on at the Mines and Money Conference?
We're not allowed to say, unfortunately. We're regulated by securities regulators in 2 countries, so I have to be even more reticent than most people that you normally interview. Suffice it to say that if you are as large as Sprott is, you have shareholdings in a very large number of mining companies, which of course we believe to be the finest.
Well, can you comment on any other resources at this time?
Well, I think that's a great question. You know, the truth is everybody's attracted to the gold stocks now after they've performed. It's odd that the TSXV, or at least a subcomponent of the TSXV, is up by 150% in the gold stocks, and it's a consequence of it being up, people are coming to it. One makes money in these businesses the way Wayne Gretzky played hockey. You don't skate to where the puck is. There's a bunch of mean guys with sticks. You skate to where you think the puck is going to be.
Right.
And I think that investors now need to look beyond gold. Investors now need to look at other places that they've made money in the past. Even the pariahs. I think you have to look at coal. You have to look at zinc. You have to look at nickel. You have to look at copper. You have to look at uranium. You have to look at platinum and palladium. Yep, skate to where the puck is going to be, not to where the puck is.
Very good. Very good analogy for us. Lastly, talk about the Mines and Money Conference in Toronto with us. What does it compare like to London or Hong Kong?
Well, this is the maiden voyage for them in Toronto, but it was important for Mines and Money to come to Toronto. Mines and Money Hong Kong is a fantastic show to meet for the new consumers of metals, the Asian investors, the Asian governments, to meet the mining industry. London is the traditional capital of mining finance, but Toronto is the capital of small cap mining finance. And so the moving of the Mines and Money institutional franchise to Toronto is good both for the conference, but in particular it's good for the Toronto mining community. It's a necessary move.
Well, thank you so much for sharing everything with us today.
A pleasure. Thank you for the opportunity.
For more Mines and Money coverage, make sure to check out more videos on our website, SmallCapPower.